I think obviously when we talk about the idea of putting a deal together or due diligence together, there are some factors which are going to influence our decision making when it comes to the type of real estate we kind of put together and the type of real estate we don't.
You're listening to Property Investor Tales, stories from the front yard. Here's your host, Tabitha Bright.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha Bright and I'm the head of coaching here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your journey that little bit easier and will inspire you along the way. Now, today I have a very special guest, none other than Sam Saggers, who's our head of strategy here at Positive Real Estate. He's in charge of the acquisitions team, so the team that go out and find deals for our fabulous clients. And he's going to take us through exactly how they source those deals, all the considerations. And it's as much about what doesn't pass muster as what actually does. So enjoy this conversation with Sam Saggers. Today, I'm super lucky to be interviewing Sam Saggers. Now, Sammy is the head of strategy here at Positive Real Estate. One of the owners of the business. And I'm super fortunate to have him because we're going to pick his brains. We always talk about the deals we do and how fantastic they are. But today I want to talk about the deals that we don't do. So Sammy, welcome to the podcast.
Thanks, Tab. Thanks for inviting me along. Yeah,
well,
glad to be here. Glad to be here. Glad to talk about real estate.
Yeah, well, we had a bit of a request from the coaches actually, because, they're often talking with clients about property deals. And one of the things that people don't often realize is how many deals that we don't do. So do you want to take us through your team as the acquisitions team? Do you want to take us through the process that you go through when you're looking at deals?
Yeah, for sure. Obviously there's a lot of real estate out there and, some of it's good, some of it's mediocre, and some of it's, stock which you probably wouldn't want to take into your retirement. I think obviously when we talk about the idea of putting a deal together or due diligence together, there are some factors which are going to influence our decision making when it comes to the type of real estate we kind of put together and the type of real estate we don't. And really, I guess when it comes down to our selection criteria versus the real estate we don't want to partake in, there's a huge checklist. And I think, to go through that, I'm more than happy to, but it's going to take us about an hour and 20 minutes. But to sort of, I guess,
paraphrase,
simplify it. Obviously, when it comes to real estate, there's ways to look at real estate from a due diligence point of view. And really the 5 key principles of due diligence is macro due diligence. What's a city doing? What's a state doing? Macro due diligence is quite often where a lot of property investors start and finish. For example, you'll hear someone say, oh, the Darwin market's doing well, I'm going to go buy in Darwin, or the Perth market's hot, I'm going to go buy in Perth. Obviously, from a macro point of view, if we were to look at a marketplace, we want to look at the health of the economy, jobs, infrastructure, population. We also want to look at some of the trends, things like supply versus demand, rents. We want to look at the overall health of a marketplace. But macro, I guess, due diligence is really a health metric. It doesn't determine the rate of capital growth, which is more so local factors. So the first thing we would look for is macro factors. Is there something good about a city to invest there? And is the type of place whereby someone should own an asset in their retirement in that city at a macro level? Some cities at a macro level, as you know, Tab, we wouldn't want to partake in. And the real reason is there is a difference at a macro level between population, infrastructure, and jobs, pie, or population, infrastructure, and employment.
Mm-hmm.
Two, at a macro level, supply versus demand, demographics, and rents. So what happens is a lot of property investors will look at a city and go, the rents are climbing, or it's the demographics, there's wealthy people coming to that area. And really that's a trend. And those trends also happen in cities. But what happens in many, many smaller places, regional areas, they get affected by a trend, i.e. rents growing, and then people want to invest there. But there's no pie economics. There's no population growing.
Yeah.
There's no government infrastructure spend. Really, there's no jobs other than the jobs that are there. There's no new job creation. So the first thing we want to do is rule out stock in areas where there is no pie economics at a macro level.
Yeah.
This is where, we look at some places where people would like to invest and go, well, does the risk equal the reward? And I like to phrase it like this. Pie economics is your defense mechanism. So that's defense. And offense is things like supply and demand, yield variation, and demographics. When a market at a macro level has both, we'll look at all the real estate in that marketplace.
Yeah.
So that's rule one. We rule out, obviously, properties where the long-term fundamentals are risky, and stick to areas where the long-term fundamentals carry less risk, less volatility, high economics. And that's why typically you'll often see us just keep it simple. There's good properties in Brisbane. There's great properties in Canberra. There's great properties in Melbourne. You don't need to take the risk of Humpty-Doo.
Yeah. Because can I just reiterate something really important there? You said often we keep it simple, and sometimes I think people mistake complicated with a great result, and they think that the more complex a deal, the more they've put together, i.e. a development or something creative, that it's going to get them a better result in the long term. But often it's better to go with, like you said, the strong fundamentals that just make clear sense, right?
Yeah, totally. I think as well, when you're investing, you're not investing for the person you are now. You are investing for the older version of you. So you want to have something which is easy to rent, which is simple, which is understandable as part of the puzzle. Probably the second thing that rules out a lot of real estate for us is contract law. So real estate is a real tangible asset, and it's a real title. It's a contract, and inside that contract, there are conditions to a contract. Obviously, some properties will have right of ways, some properties will have easements, some properties will have hazards, environmental hazards, bushfire attack levels. Some properties will have flood challenges. So what is very important to us is when we look at real estate, if we do our searches on the property, it may look very good at a surface level. You might see it on realestate.com. It may look like a bargain, and what you're not seeing underneath underneath, well, if you peeled the curtain back, what you're not seeing is it's subject to a road widening order, or
Right.
it's got an environmental impact, or it's on, for example, a hazardous material register. It could be on an asbestos register. So all of a sudden, the contract becomes a massive piece of the puzzle when it comes to eliminating real estate, which we don't want to be part of. And so for us, what we do inside the business is, obviously we've got a pretty adept contract law department. And whenever we're looking at a contract, we're always up front, basically sifting through the challenges with the contract and the opportunities with the contract. And so we rule out real estate that way, which is probably something you don't see a lot of, because typically, particularly, our members will probably see the shiny object that goes to market, but behind that is real estate, which we look at, we think it's good ourselves, then we'll do contract law reviews and find out it's contaminated with asbestos, and then all of a sudden the deal's off the table.
Yeah, got it. And because you guys would have, you and the acquisitions team would have developers and every man and his dog that's trying to sell real estate coming to somebody like Positive Real Estate, right? You must get approached by a lot of owner builders and people wanting to do a deal. Tell me a little bit about that, because Positive Real Estate we have some very clear guidelines that you and the guys have created over the years of people that you'll work with.
Yeah. So outside of macro due diligence and of course contract law due diligence, you've kind of got three other pieces of the puzzle to conquer before a deal becomes real. Really, you've got the physical or asset level piece of real estate. And of course, yes, you're right. There's a lot of, groups, there's a lot of developers, there's a lot of builders, there's a lot of existing vendors out in the marketplace that bring real estate in front of us. And our job is to look at that real estate to make sure it's going to create a financial outcome for the investor participating in the deal. And obviously, where that sort of sits is, for a lot of real estate, you would assess its risk. You would, for example, use risk matrix to work out whether the real estate is priced right, it's of the right ilk, it's of the right brand, to assess whether, it's something that's going to actually make people some money. Yeah. And of course, when it comes to assessing risk, there's kind of qualitative assessment and quantitative assessment. And so what happens at a qualitative or rule of thumb assessment level, we would go, okay, someone's brought us a deal. It's land in Middle Ring, Brisbane. Rule of thumb is the results of people buying and building a house 10 kilometers from a city is very good, that they're likely to make money. So we will, at a rule of thumb level, at a qualitative level, go, okay, that deal looks pretty good. Now, at a quantitative level, where you do detailed research, we would look at it in far more detail, get reports done, look at supply charts, get valuations done, check out the deal from a reputation point of view, and start to formulate whether, okay, it looks like a good deal on the surface. Can it go further when it comes to its viability as an investment for an investor? But certainly, most deals we look at don't. And really the reason as to why they don't is they'll either fail immediately a rule of thumb concept. So, for example, they might be in the middle of nowhere. What evidence is there that buying in the middle of the nowhere makes money?
Yeah.
There's none. Or they may fail more detailed review where the pricing doesn't work, where the yield doesn't work, where the lending won't work on the real estate from a valuation point of view. And so there's a lot of obviously overpriced real estate out there. And of course, when it comes to the metrics around physical real estate, you don't want it only to be the right price in the right marketplace. You want it to have the right cash flow profile in the right marketplace.
100%.
And of course, you want it to also have good street appeal. You want it to have good streetscape appeal. You want it to also be very well designed. You want good floor plans, good house plans, good functional design. So there's a lot that you have to go through to then go, well, this property looks good, but the floor plan or the house plan is absolutely terrible.
Right.
It's the right price, it's the right suburb, but it's the wrong dwelling.
Yeah.
And I always say, really, to keep it really simple for the listeners, there's three characteristics which really tick the boxes. The first one is building characteristics. The building, if it's a good dwelling, whether it's a house or an apartment or a townhome, good dwellings are obviously interesting to the marketplace. They get better rent, they get better resale. The second characteristic is the location. Obviously, better locations in suburbs get better results. Better streets get better results. Streets which are, perhaps closer to the train line, so it's walkable, not drivable, get extra benefits. And of course, then you've got the land characteristics, which is the physical address of the property and, how that pertains to the local area. Is it good land? Is it sought after land? Is it sloping land? Is it a easy block to live on? Is it got good orientation, good sunlight? So again, like the concept you need to probably understand is real estate and houses and apartments are not mandarins. They're not the same. Like they're just, everyone is completely different. And so you need to be able to go through metrics to understand the context of the asset. Because if you had two properties side by side and they had the same land characteristics, they were the same land size, and one had a better home on it and one had a home falling down, it's completely different price metrics to what it's worth. So it's horses for courses in a way.
So I guess, you start large, you've got the big stuff that you look at, it slowly gets eliminated as it comes down.
It slowly gets, so you go macro, you go contractual, you then go asset. Then you may look at, for example, price metrics. So the best way to understand price metrics are things like, estimated fair market value. Is it the fair market price or where it is in the property cycle? Is the cycle, for example, coming down in value? Does that mean you need to negotiate a lower price? Is it overpriced for a cycle coming down in value? Is it fairly priced for the start of a cycle? And really the best way to understand how to approach that is sort of three methods of valuation. You've got like for like, direct comparison, where you're simply looking at what's on the market, what price it's and what price those properties are being sold for that are similar. And then, of course, you're looking at the cost to build real estate, known as summation. That's where you're analyzing square meter rates.
Yeah, I like.
And of course, you can look at, for example, the cap rate or the yield to see if it's better than market and better than other assets. So again, you would eliminate a lot of real estate because the yields don't work, or the cost to build it is too expensive, or there's really a lack of comparable supporting information to recognize the real estate.
The price.
And we know real estate's a humanistic sport that you put three buyers in a house on the weekend to buy a property, they're all going to have three different opinions of price.
Yeah.
You put three buyers agents in a house on the weekend, they're all going to have three different opinions on price. You put three valuers in a house on the weekend, they're all going to have three different opinions on price.
Correct.
But the main thing is you do see where, and I'm not talking at, $5,000 level, I'm talking at $100,000 level. It's very, we're very capable of going, that asset is $100,000 overpriced.
Yeah.
And going, don't go near that asset.
Yeah.
So yeah, you're looking at sort of macro, you're looking at contractual, then you're looking at obviously the physical asset. What does it look like? How does it feel? Has it got good floor plans? Is it well designed? Has it got nice fixtures and fittings? Is there a benefit to the dwelling? Then you're looking at price. And then you really go into localized macro factors where you're starting to drill into the suburb and starting to work out, well, where in the suburb is it? What does zoning look like in the suburb? You might have a really good property brought to you or find a really good property. Then all of a sudden you realize there's thousands more properties coming to that suburb.
Okay, yeah.
And of course, for someone looking on realestate.com, they're not looking over the horizon. They're actually just looking at what's in front of them today. Oh, this property is really, really good. And of course, when you look into some of the zoning data or supply facts, what you realize is might be a good property, but the landscape of that suburb is going to change dramatically because 3,000 apartments are about to be completed, and it's going to dramatically change the outcome of the investment for a period of time. Of course, these are some of the things that, we've got to go through to try and assess a piece of real estate to make sure it's going to work out.
And so tell me, how many deals would you guys look at a month, and what would make it through? Have you got any kind of metrics on that to give clients an idea?
Yeah, well, the old rule of thumb was look at 20 deals, one kind of stacks up. And I know, we used to even train clients to have a go themselves. They used to get a bit frustrated because it was like homework they didn't have time to do. We'd say,
it wasn't very popular.
No, we'd say a challenge, go and look at 20 properties and find one which stands out.
Yeah.
And it fairly well is the same metric. I mean, every single day I've got really my inbox set up to basically receive a lot of real estate deals. And then we've got obviously our internal team that go out fossicking for real estate deals. And yeah, most of them don't stack up. So it'd be a pretty similar metric, 20 to 1.
Yeah.
Whereby we sort of, it's not that we don't turn them down, it's that we don't even, some of them look at them because we know from a qualitative and quantitative level, they're just not the right fit. Like you can, I guess as you do it for, more you do things, you can sort of quickly go, you just sort of like, oh, that's not going to work. Yeah. So it's quite quick for us, but for other people, obviously, there's a lot to work through.
Yeah, I remember we used to, when I was a mentoring client, however many gazillion years ago, Jason used to make us all put out 15 to 20 offers a month to get 3 that were accepted, to get 1 that went to contract. And it was, nobody did it. Nobody had the time. And then you get caught in this thing where the agents keep calling you back, and your time just goes out the window. It's nuts.
Yeah.
It just becomes this
And
accumulating thing.
And I think as well, like, it really comes down to obviously your strategy as much as anything else. And, we tend to focus on, buy, hold, depreciate, and recycle equity.
Yeah,
so
absolutely.
what we have found over the years, that pricing that property, we've become quite expert at it. So you're buying something, you're holding it, you're getting your allowances through depreciation, and then recycle the equity and go again, as opposed to sort of buy, hold, renovate, and recycle.
Yeah.
As we know, like, probably what happens is a lot of investors will have a look at the secondhand market compared to the brand new market, which is very, very important thing to do. And what we call that in real estate is the price delta between new versus old. The average price delta is basically a metric where you're going, well, is it actually cheaper to buy new than it is to buy something equivalent and renovate it? Because it's not a fair equation if you don't take into consideration when you're doing the analysis on secondhand. And we list some secondhand properties as well. But really what you've got to understand when you're doing a buy, hold, renovate, recycle strategy, there's a different square meter rate, for example, to remove something from a property or to replace something than it is to rebuild something in a renovation.
Yeah.
The 5 R's of renovation: retain, rebuild, replace, remove, or repair. You might look at a property and it might be 200 square meters of home, but 100 of square meters of that needs to be rebuilt, totally gutted and rebuilt. And as you know, Tab, I think we saw this on the Facebook group, it's a 4,500, 5,000 a meter exercise.
100%.
So you're talking hundreds of thousands of dollars. And so what a lot of deals we look at when we're analyzing the secondhand market, we're also analyzing the capital expense to bring the property up to a point where the investor doesn't need to look after it for 30, 40 years. And so, because that obviously we're in the business of helping people reach their retirement goal. And if you're going to take on an asset and be going to Bunnings every weekend and, trying to sort of, run it that way, you're going, it's going to be a bit of a nightmare for you. You probably get sick of the asset. So you've either got buy, hold, depreciate, recycle, or buy, hold, renovate, recycle. No right or wrong. It's just you've got to do the maths correctly. And that's where a lot of stock we would eliminate from the secondhand market, just because by the time you do your 5,000 a square meter rebuild on the renovation, different to maybe, replacing a tap or something like that. Yeah. But a total new kitchen, new bathroom, like, it doesn't mathematically work.
No. And I know we've gone through the numbers on that in the past and had a look at stuff. The only other thing I wanted to touch on with you today was the developers and the level of developer that we choose to work with, because I think this is really important. And, clients have often heard us talk about how we're very particular about who we work with. And you guys have obviously done a lot of due diligence on the developers, on, as much as you can on a company, how fiscally solid they are, their reputation in the market, the quality of the product they deliver, renders versus reality, all of that stuff. You guys do a lot of work in that space as well.
Yeah. And sort of what tends to happen in a softer market. I mean, one of the opportunities for property investors is to actually buy a higher quality asset because there's more choice. In a high demand market, quality disappears from the marketplace a lot of the time. And so one of the fads that people fall into is in a FOMO market where there's a lot of sales happening and stock is hard to get.
Yeah.
People sort of buy anything and sometimes turn their back on one of the big fundamentals of real estate, which is to buy a very good dwelling. Inside of the brand that we prefer to align with, obviously there's a lot of experience. They tend to be household names that deliver a lot of the products we put together, not all. And sometimes because people have certain appetites, there is the propensity to go outside of our risk matrix. And sometimes people want something unique to themselves where we do take on that type of work.
Yeah.
But 95% of what we do is we tend to look for some of the better developments in Australian real estate. A lot of them we note come by virtue of their credentials. You'll find that most of the people that we would align with win awards at the UDIA, for example, the Urban Development Institute of Australia, or the HIA award, which is a building award.
Yeah.
So a lot of our people we prefer to work with tend to have a high propensity to like good architecture. They have a propensity to want to make sure their reputation is probably more important than the property deal. They're design and floor plan experts when it comes to what they deliver. They believe in high quality fixtures and fittings. They understand that we're investors, but their predominant focus is actually helping residential homeowners.
Yeah.
And they give us an opportunity to often be part of something which is designed for the home buyer marketplace. The assets that they tend to deliver are both appealing in a boom, but also appealing in a decline, which is very, very important to protect downside risk. They tend to be the type of people who have the propensity to help solve problems. After even purchase, they will care about their defects in the building. They will be part of the community if it's a larger scale development and make sure the community is embedded before they leave. They will run community events to get things going. Sometimes they're invested themselves in the hold strategy within a building or a neighborhood. They own real estate.
Cool.
They're your neighbors.
Yeah.
So they generally do the right thing. And there's sort of plenty out there where, it's a lot tougher to get that kind of relationship with.
Okay, that's really cool. And so wrapping up, anything else that you think is important that clients need to know about how Positive Real Estate locate deals and as much what we don't do as what we do?
Well, again, there is a rationale behind what we do. I guess, there's plenty of deals that, we veto because the price matrix doesn't work. The lending matrix doesn't work. The brand matrix won't work. the macro market doesn't work, the micro market doesn't work, and or the contract doesn't work. So yeah, there's obviously real estate out there that we don't see that's absolutely gold. But I certainly believe the results are in what we do, and we're, I think, very well class in what we bring to our customers.
Yeah.
And the results are in through the last few years, you're just seeing valuations are always coming in on the dollar. You're seeing valuations even coming in above purchase price, even though the market's cooled. I mean, we're in a cool market right now. We're handing over properties, valuations are coming in above. So the maths works. And again, like, I tend to suggest that we're pricing experts, and we actually are capable of pricing real estate to the dollar, and 95% of what we suggest to buy comes in on the dollar at the price we suggest to buy it at. Around 5% of it comes in under, with a variation of around 5%. So that sort of, if something's 500,000, it could come in at 475 on bank val. But that's 5% of what we do. And usually, as you know, it's a bit of doing another valuation or changing lender, or we work out the lender's overexposed in that neighborhood.
Yeah.
So, very much, I would say we're experts at pricing. We're experts at macroeconomics as to where market perhaps is overpriced. We're definitely design experts when it comes to how a property should look and feel.
Yeah.
Not overcapitalizing, not undercapitalizing. We're square meter experts when it comes to the cost of delivery. And it doesn't always go to plan, but it's usually not far off. And that's real estate. It's not a linear thing. It's got plenty of things to overcome. But I always say this, if you're going to be an investor, look forward to buying problems, because when you solve them, you actually create money. And that's the riddle.
Fantastic. And it goes back to what Jace always says. Yes. It's a marathon.
Buy well, never sell.
Buy well, never sell. It's a marathon, not a sprint. That one's for you, Witten. Awesome. Well, thank you so much, Sam. Guys, I hope that was really valuable, but gives you a bit of an insight into what we do here at Positive Real Estate, with the acquisitions team led by Sam Saggers, doing a cracking job getting deals for clients. So thanks so much, Sammy.
Thanks, Tab. See you.
Bye. Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.